Hey everyone, welcome to our beginner's guide to investing. Today, we are going to dive into the exciting world of investing and help you understand the basics so you can kickstart your journey towards financial freedom. Why invest early? Now, let's talk about why it's crucial to start investing early. The key here is compounding. Compounding is like a snowball effect for your money. When you invest, your money has the potential to earn returns. Those returns can then generate their own returns and so on. The longer your money has to compound, the greater the impact it can have on your wealth over the time. Let's illustrate this with an example. Consider two individuals, Michael and Sarah. Michael chose to save $1,000 per year for 30 years in a regular savings account, earning 2% interest annually. Sarah, on the other hand, decides to invest $1,000 per year starting at age 25, and she earns an average annual return of 10%. By the time Michael reaches age 55, his savings has accumulated to around $42,379. On the other hand, Sarah's investment have grown to $181,943 thanks to the power of compounding. Now, would you rather be Michael and let your money sit dormant in the saving accounts, or would you rather be Sarah and harness the powers of investing and grow your wealth over the long term? By starting early and harnessing the powers of compounding, Sarah ends up with more than triple the amount of wealth compared to Michael, even though they both save the same amount each year. Let's see what you think. Comment below 1 if you'd rather be Michael, or 2 if you'd rather be Sarah. So, whether you're in your 20s, 30s, or even 40s, don't delay. Start investing as soon as possible to take full advantage of the power of compounding. Other than the ETF and cryptocurrencies, we are going to explore the investment opportunities, so make sure you watch this video until the end. Alright, let's lay the groundwork for your journey into investing. In this section, we are going to cover the fundamental principle that you need to understand before diving into the world of investments. Investing is essentially putting your money to work with the aim of earning a return on it. Instead of letting your money sit idle, you are allocating it to assets like stocks, bonds, real estate, mutual funds, or ETF with the expectation that they will appreciate in value or generate income over time. Investing involves balancing risk and return. Every investment carries some level of risk, and generally, investments with higher potential returns also come with higher level of risk. For example, while stocks have historically delivered higher returns than bonds or saving accounts, they are also more volatile and can experience significant fluctuations in value over the short term. On the other hand, safer investments like government bonds or saving accounts offer lower returns but come with less risk. To manage the risk, it's important to diversify your investments. Diversification simply means spreading your investments across different assets and asset classes. By diversifying, you can reduce the impact of any one investment performing poorly and help protect your overall portfolio. This is a key strategy for building a resilient investment portfolio that can weather market volatility and provide more stable returns over time. It is essential to understand the different types of investment assets available to you. Stock represents ownership in the company. When you buy shares of stock, you become a partial owner of the company and are entitled to a portion of its profits in the form of dividends. Stocks are considered one of the risky investment assets as their value can fluctuate significantly based on company performance, market conditions, and economic factors. If you'd like a deep dive into the world of stock investing, I'm offering our stock investing masterclass for free to you. This masterclass normally costs $300, but we are giving it away to the first 1,000 people who sign up. Don't miss this opportunity and sign up now while it's still free before my team takes it down. You can find the link to the free masterclass in the description or the pinned comment below. Alright, let's continue. Bonds are debt securities issued by governments, municipalities, or corporations to raise capital. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of the bond's face value at maturity. Bonds are generally considered less risky than stocks but offer lower returns. Alright, real estate refers to physical properties such as residential homes, commercial buildings, or land. While real estate can provide steady income and diversification to an investment portfolio, it also comes with risks such as vacancies, property maintenance costs, and market fluctuations. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers who make investment decisions on behalf of investors. Mutual funds offer diversification and are suitable for investors who prefer a hand-on approach to investing. Commodities are raw materials or primary agricultural products that can be bought and sold, such as gold, oil, wheat, or coffee. Investing in commodities can provide portfolio diversification and protection against inflation, but they can be volatile and subject to supply and demand factors. Exchange-traded funds ETFs are similar to mutual funds, but trade on stock exchanges like individual stocks. They offer investors exposure to a diversified portfolio of assets, such as stocks, bonds, or commodities, and typically have lower expense ratios than mutual funds. ETFs provide flexibility, liquidity, and cost effectiveness for investors. Of all of these different investment types, ETFs are considered one of the most beginner-friendly options. Firstly, they offer simplicity and accessibility. With just a brokerage account, investors can easily buy and sell ETF shares at market prices throughout the trading day. ETFs typically have lower minimum investment requirements compared to mutual funds, making them accessible to investors with limited capital. One of the key advantages of ETFs is their ability to provide instant diversification. ETFs hold a basket of securities, such as stocks or bonds, within a single fund. By investing in an ETF, you gain exposure to a diversified portfolio of assets, spreading out your risk across multiple investments. This diversification helps mitigate the impact of any single investment performing poorly, providing stability to your portfolio. Session 2. Exploring ETFs, exchange-traded funds. In this session, we will break down what ETFs are, how they work, or why they are a fantastic choice for those who are just starting their investment journeys. How ETF works and their roles in diversification. When you invest in an ETF, you are essentially buying a share of a diversified portfolio of assets, such as stocks, bonds, or commodities. This allows you to spread your investment across multiple securities, reducing the risk associated with any single investment. ETFs can provide exposure to a wide range of sectors, regions, and asset classes, allowing you to build a well-rounded investment portfolio with ease. Popular ETFs tracking broad market indexes. Some of the most popular ETFs track broad market indexes like the S&P 500 or the Nasdaq. These indexes represent a basket of stocks from hundreds or even thousands of companies, providing investors with exposure to the overall performance of stock market. Examples of popular ETFs including SPDR, S&P 500 ETF, SPY, and Invesco QQQ, Trust QQQ, which track the S&P 500 and the Nasdaq 100 respectively. Choosing the right ETF. Selecting the right ETFs requires careful consideration of several factors. Number 1. Investment objectives. Determine your investment goals and objectives. Are you looking for growth? Are you investing the short term or for the long term? Your investment objectives will guide your selection of ETF. Number 2. Risk tolerance. Assess your risk tolerance. Some ETFs may be more volatile than others, depending on the underlying assets they hold. Consider your comfort level with market fluctuations and choose ETFs that align with your risk tolerance. Number 3. Asset class and sector exposure. Decide on the asset classes and sectors you want to invest in. ETFs are available for various asset classes, including stocks, bonds, real estate, and commodities, as well as specific sectors like technology, healthcare, or energy. Choose ETFs that provide exposure to the asset classes and the sectors that fit your investment strategies. Number 4. Expense ratios and fees. Pay attention to the expense ratios and fees associated with each ETF. Lower expense ratios translate to lower costs for investors, allowing more of your investment return to compound over time. Look for ETFs with competitive expense ratios and minimal fees. Number 5. Tracking error and liquidity. Consider the ETF's tracking error and liquidity. A low tracking errors indicates that the ETF closely mirrors the performance of its underlying index, while high liquidity ensures that you can easily buy and sell shares without significant price fluctuations. Number 6. Historical performance. While past performance is not indicative of future results, it can provide insights into how an ETF has performed in various market conditions. Review the historical performance of ETFs, but keep in mind that future performance may differ. As a general guideline, historical data has shown that over the long term, diversified stock ETFs have yielded average annual returns ranging from 7% to 10%. Cryptocurrencies. Now, let's dive into the exciting world of cryptocurrencies, why they have captured the attention of investors worldwide, and what you need to know before considering investing in them. Cryptocurrencies and blockchain technologies. Cryptocurrencies are digital or virtual currencies that use cryptography for security and operate on decentralized networks. Based on blockchain is a distributed ledger technology that records all transactions across the network of computers in a secure and transparent manner. Without the need for intermediaries like banks or governments, these technologies ensure that transactions are immutable, transparent, and resistant to censorship. So basically, cryptocurrency are like online money, but instead of paper notes or metal coin, they exist only in computers. Unlike regular money controlled by banks or governments, cryptocurrencies don't have a boss. No one tells them what to do. Cryptocurrency use secret codes to keep transactions safe. It's like having a secret handshake to share money online. Most cryptos use something called a blockchain. Think of it as a super secure digital notebook that keeps track of all transactions. The appeal of cryptocurrencies offers several attractive features for investors. Firstly, they provide decentralization, meaning they are not controlled by any single entity or government, which can appeal to those seeking financial freedom and auto. Additionally, cryptocurrencies have the potential for high returns, as seen by the significant price appreciation of coins like Bitcoins and Ethereum over the years. Moreover, cryptocurrencies enable fast and low-cost cross-border transactions, making them an appealing option for international payments. Popular cryptocurrencies. Bitcoin, the first and most well-known cryptocurrency, was created in 2009 by an unknown person or group of people using the pseudonym Satoshi Nakamoto. Bitcoin serves as digital gold and a store of value with a limited supply of 31 million coins. Ethereum, launched in 2015 by Vitalik Buterin, introduced the concept of smart contracts and decentralized applications, DApps, making it a versatile platform for building decentralized projects and tokens. Risks associated with cryptocurrency investing. While cryptocurrencies offer exciting opportunities, it's essential to be aware of the risks involved. Cryptocurrency markets are highly volatile, with prices subject to significant fluctuations in short periods. Regulatory uncertainty and potential security vulnerabilities also pose risks to investors. Additionally, the anonymity and irreversibility of transactions can make cryptocurrencies susceptible to fraud and hacking attempts. When you use cryptocurrencies, your identity isn't directly tied to your transactions. It's like wearing a digital mask. While this privacy is great for users, it also attracts bad actors. They can hide behind an anonymous mask to carry out fraudulent activities without leaving clear traces. Once a crypto transaction happens, it's permanent. You can't hit the undo button. Imagine writing in ink instead of pen. If someone tricks you or steals your crypto, there's no way to reverse it. Traditionally, banks can sometimes reverse transactions, but not with cryptos. Hackers love this feature. They can grab funds and vanish. For beginner investors. For beginners interested in investing in cryptocurrencies, it is crucial to conduct thorough research and exercise cautions. Start by educating yourself about blockchain technology and different cryptocurrencies. Only invest what you can afford to lose. As the cryptocurrency market can be unpredictable, consider diversifying your investment portfolio and using reputable cryptocurrency exchanges or wallets to store your assets securely. And most importantly, stay informed about the market developments and be prepared to adapt your investment strategy accordingly. Cryptocurrencies represent a groundbreaking innovation in the world of finance, offering decentralization, potential for high returns, and fast, low-cost transactions. However, they also come with risks and require careful consideration before investing. By understanding the fundamentals of cryptocurrencies and exercise cautious, beginner investors can navigate this exciting but volatile market with confidence. Before we dive into the new and exciting investment opportunities for this year, make sure to leave a like and subscribe if you want to see more finance and investing content like this. Let's now explore the dynamic landscape of new and exciting investments for the upcoming year. In this section, we are uncovering emerging trends, innovative technologies, and promising opportunities that investors should keep an eye on. Emerging investment trends. Several emerging investment trends are shaping the future of investing. One such trend is the rise of the renewable energy. With increasing global awareness of climate change, investments in renewable energy sources like solar, wind, and hydroelectric power are gaining traction. Companies involved in clean energy productions energy storage, and electric vehicles represent exciting opportunities for investors looking to align their portfolios with sustainable initiatives, innovative technologies, and industries. The year is poised to witness significant advancements in innovative technologies that have the potential to disrupt various industries. Artificial intelligence (AI) continues to revolutionize sectors such as healthcare, finance, and transportation, offering opportunities for investors to capitalize on AI-driven solutions and platforms. Additionally, advancements in biotechnology and genomics are paving the way for groundbreaking discoveries in personalized medical, gene editing, and regenerative therapies, representing compelling investment prospects. Potential growth area. Investors should also pay attention to potential growth areas that are likely to shape the investment landscape. This may include sectors such as cybersecurity, as the digitalization of businesses and increasing cyber threats drive demand for cybersecurity solutions and services. Furthermore, the space exploration industry is experiencing rapid growth, fueled by private companies' initiatives to explore space tourism, satellite deployment, and asteroid mining, offering unique investment opportunities for those interested in the final frontiers. New investment vehicles. In addition to traditional investment instruments, new investment vehicles are emerging, offering investors alternative ways to participate in the market. Special purpose acquisition companies, SPACs, have gained popularity as a vehicle for taking private companies public, providing investors with access to early-stage growth companies. Similarly, non-fungible tokens, NFTs, have captured as digital assets representing ownership of unique digital items, such as artwork, collectibles, and virtual real estate, creating a new avenues for investment and creativity in the digital economy. Tips for identifying promising opportunities. As investors navigate the evolving landscape of new and exciting investments, it is conduct thorough due diligence and research. Stay informed about emerging trends, industry developments, and regulatory changes that may impact investment opportunities. Diversify your portfolio to spread risk across different asset classes and sectors. Consider seeking guidance from financial advisors or investment professionals to help identify promising opportunities aligned with your investment goals, risk tolerance, and time horizons. By staying informed, conducting due diligence, and remaining adaptable to market dynamics, you can position yourself to capitalize on the potential rewards of all these evolving investment landscapes. Throughout this video, we have covered essential concepts from the basics of investing to exploring various investment options and emerging trends. As we conclude, let's recap some key takeaways. Start early and stay informed. Investing early and consistently can significantly impact your financial future. Take advantage of the power of compounding by starting your investment journey as soon as possible. Stay informed about market developments, emerging trends, and investment opportunities to make informed decisions. Diversify your portfolio. Diversification is a cornerstone of a investment strategy. Spread your investment across different asset classes, sectors, and geographical regions to reduce risk and maximize returns. Remember not to put all your eggs in one basket. Understand risk and reward. Investing involves risk, and it's essential to understand the relationship between risk and reward. High potential returns often come with higher levels of risk. Assess your risk tolerance and investment objectives carefully to build a portfolio that aligns with your financial goal. Keep costs low. Minimize investment costs by choosing low-cost investment vehicles like ETFs and avoiding unnecessary fees. Every dollar saved on fees is an additional dollar that can compound over time and contribute to your investment returns. Stay disciplined and patient. Investing is a long-term journey, and success often requires discipline and patience. Stay focused on your investment plan. Avoid making emotional decisions based on short-term market fluctuations, and maintain a long-term perspective. Remember, investing is a journey, not a destination. By following these principles and staying committed to your investment plan, you can build a strong foundation for financial security and achieve your long-term financial goals. Now, it's your turn to step up your investment game. To help you on your investment journey, to reward yourself for watching this video to the end, sign up for the free masterclass now before my team take it down. You can find the link to the free masterclass in the description or the pinned comment below. Thank you for joining us on this journey. See you in the next video.